if you look at the chart of Amazon, Apple, Google, Facebook, all of these, on a logarithmic chart, they're almost perfectly smooth trends. They're network adoption models. But when you look at them normally, they look like they go up and down a lot. Yes, they do, but within a consistent, secular, powerful trend. Once I saw that, I'm like, if our job is to make money, then this is the trend you need to be on, the secular trend, because it's driven by the central banks. It's driven by technology itself, but then also driven by the central banks debasing. So you get the double whammy from it. It's like, okay, this is perfect. And it also is the answer to the massive macro problem of excess debt and slowed GDP and aging populations. So when you've got something that's so against the persistent narrative that everything's screwed and it's all going to go wrong, and you see it and do a lot of hundreds of hours of research on it, and you come up with a completely opposite view, it's like, oh my God. And then I started surfacing that view for Global Macro Investor and then within Real Vision and elsewhere, and it was like a light bulb moment for people. They're like, oh my God, suddenly now understand why things are happening as they are, why technology stocks keep outperforming, why crypto keeps going up. Excess manipulation of money blows up the entire system. And that's a lot of people hold that view, that you end up with a hyperinflation or something of that sort, a total economic collapse. But I struggle to get to that answer, because in every circumstance, when asset prices collapse or something goes wrong, they just print money. And when you're the world's reserve currency, it's difficult to hyperinflate it. So what you end up with is this rise in asset prices, which then gets rid of this ability to have this massive downside. So I think we've taken the big downside away. Well, we've traded it off for something else, which is everybody's incomes basically get poorer in purchasing power over time versus assets. But I don't see... Okay, the other downside people would say is that the excess use of monetary policy creates sticky inflation, and that therefore interest rates need to be higher. I started to look at all assets versus each other to say, if you're going to take risk, where do you take it? And everything was inferior to crypto. And I'm like, it becomes very difficult. If you look at it, the best performing asset for 3 years out of 4, every single year since 2009 has been crypto. And then there's 1 year, which is a bad down year, and then it continues. And the down year, it's the worst performing asset. But over time, it's compounded higher than any single asset class we've ever seen in history. So if that's the case, every other trade-off is suboptimal. Now, I can take that risk because I have income and I've got, assets. So I can take big risk because I think this is the biggest macro setup of all time. So I'll take that risk. But for other people, you can express some of these views without taking as much risk. If you believe in the debasement of currency, yes, you can use gold, but gold hasn't offset it very well. Yes, you could be cyclical and trade commodities. There'll be, as soon as we start going to macro summer, commodity prices will rise. You can make money from that. You can make money from, buying banks at the bottom of the cycle. You can make money lots of ways. It depends what your objective is. People have just realized it is the mega trend. Now, again, it's not for everybody. You have to deal with some huge ups and downs. But, there are ways of playing it in the equity market, stuff like Coinbase, stuff like that. Or otherwise, I just think you're going to be underperforming the debasement of currency. So the standard, I'm going to stick my money in the S&P 500 ETF, you're just not going to get anywhere. That house price is still going to go up, and you're just not going to make it any excess returns. And that, it's a really serious situation. People don't want to understand it. They don't like this narrative. They don't like to be told that, most assets aren't worth investing anymore. But it's true. And just look at the price action. And even if you take crypto out because you're not a crypto person, justified any asset by the NASDAQ. Just crushed them all. And then people say, well, it's going to mean revert. I'm like, what is going to stop this technological revolution accelerating? If you can find me a reason that this stops, as opposed to the business cycle, rates go up, blah, 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 it comes down. I can't find reasons. Just when you throw AI, robotics, what's going to stop this? What's going to stop Google going up? Even if they destroy their business model of advertising, they still have a lot of the technology. It's very hard to keep down technological advance, particularly when it's in monopolistic powers like these large tech firms. Last year, the number of active wallets in crypto grew 42% in a year when the market went down 80%. That's like, oh my God. We're now at 516 million users. By the end of 2030, we'll be well over 1 billion users, maybe 2 billion users. So it is a very prevalent technology, and it's happening this cycle everywhere, kind of everything everywhere all at once. The banks are using it. They're already trying to settle securities on it. They're using it for payment systems. We're seeing Visa using it for payment systems. We're seeing mega brands like Mercedes-Benz or Starbucks using Web3 NFTs. We're seeing Hermes, LVMH as a broader company adopting this. We are seeing the ongoing adoption globally of cryptocurrency as an investment vehicle. We're seeing the institutions investing in it. It's the down cycle where you add that makes you all the money. So I spent all of last year buying Solana, Ethereum into the massive sell-offs, because then you compound much faster. So you should be embracing the volatility if you've got a long-term view. If your view is 1 year, 1 year, 3 years, 3 months, it's much harder to deal with. It's so volatile. But when you just zoom out, so it's a psychology change of understanding long time horizons. And I've found that long time horizons are a superpower. Most people can't do it. Markets don't like rates going from 0 to 5.5% in record time. But even if rates stay at 5% for the next 10 years, it's not going to stop people buying technology stocks. Why? Because their ROI is much higher than 5%, so nobody cares. And most of those technology stocks don't have debt, so they have cash. And their cash on their balance sheet is going up at 5.5% a year because they're putting it into bonds. So it's this compounding effect for these companies that is so powerful, it's difficult to change.